Hello and welcome to our video lecture for topic 44, which consists of characteristics and income taxation of business entities. Thus far in the course, we've only discussed taxation and calculation of various taxes such as AGI, adjusted gross income, and then certain deductions. Now we're actually going to move a little different into taxation of business entities. So there are various types of entities as you see here. So we have the sole proprietorship, which is usually one owner. Partnerships can also take the forms of LLPs or LLCs. And partnerships have two or more owners. Then you have LLCs, limited liability companies. You have corporations, which you can have an S Corp or a C Corp. You can have trusts, you can have estates, and other associations. So we're going to cover the various taxation for each of these. So basically, you have, from a financial planning perspective and from an income tax planning perspective, you have to know the formation of the business. You have to know how that formation, for example, if it's an S Corp, then there would be a flow through of income and losses via a K-1 to the personal tax return. Same thing with partnerships. So depending on the formation, it's how the flow through of income and losses. Are they going to flow through directly to the individual's tax return, or is it going to be at the entity's return? For example, in the C Corp, all of the income and losses stay within the C Corp. There are certain special taxes. You might have distributions of partnerships. You might also have a dissolution of a partnership or a disposition altogether. So we're going to discuss all of those in this topic, and each one of them is very important because there are several questions on the CFP exam, Certified Financial Planning exam, that goes through all the nuances of these. So as I've mentioned earlier, you would really want to have some high-level notes because, again, these topics are only the income tax planning section of the CFP exam, and there are several other sections. So the more condensed you have all of this information into just a set of notes, it'll be easier for you to study. Some people like notes electronically. That would be my preference. Others like flashcards. Whatever works, that you can just make sure you have all of this information readily available. So now moving on to our sole proprietorship. There are advantages to establishing sole proprietorships. There's really no legal requirements and you don't have any separate returns, right? You have your Form 1040, which is the individual's taxpayer return. Then you have a Schedule C, which would be your self-employment information. So it's pretty easy. The disadvantages, which I find the most difficult one, is unlimited liability. So as a business owner, you are not only sued for your business assets, but you can also be sued for your personal assets. And since there is no separation or limited liability, you have difficulty in raising capital. As a sole proprietorship, basically you don't go out and get stock from other companies, or you're not able to issue stock as an IOP. And the sole proprietorship lacks business continuity because it's usually on the shoulders of that actual sole proprietor. So even though several companies are formed as a sole proprietorship and several small businesses, about 89% of them are in the sole proprietorship small business arena, there are other forms that you can take into consideration. For example, a general partnership is another type of a business entity. Some advantages is now you have a formal partnership agreement. So there are particulars that are lined out. It's not required, but I would highly recommend it because then you have what each partner is bringing to the entity, what they're going to get out of the entity. The good thing is that there's no double taxation. If you remember, double taxation is in C Corps. But at the partnership level, there isn't, because all of the income and all of the expenses from the partners goes through to their individual returns. Now, there are disadvantages in a general partnership ownership as well. It's basically the partner is, again, jointly and severally liable. They also, as partners, now you may need approval from other partners to transfer ownership. And similar to the sole proprietorship, you may have difficulty in raising capital. Now, when you have a limited partnership, now each limited partner, what they're liable for is only up until their capital contributions. So limited liability for the partners up until the amount that they put in. Again, no double taxation, which is great. We note that double taxation is mostly for corporations and C Corps, exactly. So corporations, the C Corp, an S Corp has the filing of an 1120-S, and that flows through as a K-1 through the individual returns. You might have a little bit easier time raising capital in a limited partnership because of the fact that just you have that limited liability to the partners. So that limited liability to the partners may actually help you raise capital. The disadvantages is now in this case, the partnership agreement is required. With limited partnerships, you have to have an agreement stating that your liability is only limited to the amount of contributed capital you put in. And then general partners are the ones that are jointly and completely liable. And then limited partners, though, they cannot participate in management decisions and they cannot have voting rights. So that's kind of like a yin and yang, right? So you give away, you don't have you have limited liability, but then again, you can't participate in the management and you do not have voting rights. And you may need approval of all the partners, both general and limited, in order to transfer ownership. So now we've discussed the sole proprietorship, we've discussed the general partnership, limited partnership. Now let's do a limited liability partnership. So basically back to this point is that the partner is liable only for his or her torts and not that of other partners. No double taxation, which we like, but then all partners in this case may participate in management and voting. You might see LLPs and LLCs are usually established for accounting firms. Disadvantages is as an LLP, you have to have an annual registration with the state. And then there's also, there is no double taxation, so your taxes are not filed as an entity, they're filed with the individuals. For an LLC, each member is liable back to his contributed capital, similar to like a limited partnership. No double taxation on this level either, which we're all very fond of. There are no limits on the number of members. Very easy to form, and the members may participate in management and voting. Disadvantages are usually the limitations of transferability. So that's an LLC. Again, most auditing firms and a lot of financial planners form in an LLP or an LLC way. Now, a C Corp, here we have the advantages that basically you're just a shareholder and you're only liable for your capital contribution. The C Corp has a perpetual life, right? So there's really not one particular owner. In this instance with corporations, we usually have an agent and management, right? So management has one and basically they serve as an agent for the shareholders. So it's really not a particular owner, not with the sole proprietorship, that if the owner dies, then unfortunately most of the time the company dies. There you can transfer ownership quite easily, and it's very easy to raise capital. You can do IPOs, you can go to the bank. There's just more stability within a C Corp. Unfortunate disadvantages are double taxation. Also, you have to have articles of incorporation. They are required. You need to produce an 1120, some type of tax return for the entity, because now the corporation pays income taxes and on net earnings, and you cannot deduct the dividends paid to the shareholders. So that's another disadvantage. And then the shareholders have to pay income taxes on the dividends that they accumulate, hence the double taxation. So the shareholders pay the taxes on the dividends, and then the corporation pays the taxes on what they earn, and they cannot deduct the dividends. Now, an S Corp is probably one of the most recommended forms of corporations, because basically each shareholder is liable only up until their capital contributions. You have the corporation form, but you don't have double taxation, because at the S Corp level, there are particular rules. You can't have more than 75 shareholders. The assets have to be under a certain threshold, but you file an 1120-S as your tax return. But then you go ahead and you have a K-1 that flows through to the individual tax returns. So some disadvantages is you still have to have the formal articles of incorporation, and a registration is required. You have to elect the S Corp status by the 15th day of the third month. You can't have more than 100 shareholders, and those are limited to U.S. citizens. There are limits to the transferability of stock. It can cause a loss of the S status if a shareholder dies and bequests that stock to an unqualified shareholder. Normally this is done with like small ownership strings. I've worked in companies where this has been maybe 5 or 7 people. And then the S corporation stock may only have one class, usually common, and you may have some difficulty in raising capital as with the other forms of business. So remember, it's 100 shareholders. Then for trusts and associations, business trusts, they take the legal title to the business assets, and then they manage that for the benefit of the owners. So basically the beneficiaries of the trust are the shareholders or certificate holders, like stockholders. So basically someone is running the business for that, and it's usually for the benefit of the beneficiaries. Now an association is a voluntary organization of individuals who they act under some kind of common name for a lawful purpose. You can have a profit or nonprofit association, but unlike a corporation, this association isn't really a separate legal entity. It cannot sue or be sued, and it's not subject to taxes that the corporations pay. Most associations are non-for-profit, and it's not a very common form of business entity. So hopefully now you've learned a little bit more about the various forms of corporate entities, and now you are ready to work on the multiple choice questions at the end of the topic. And I also don't forget to work on your case questions. Thank you.